Hello, hello. Normally, you folks don't like to mix with people like me. I'm a banker. And I'm here to talk about the exact opposite, the exit. And I'm very impressed with Lars, because normally, when I bring people public or I sell companies, they disappear to the famous beach or they open a bar in Mallorca. But he goes straight back to the beginning and is giving all his know-how and also some of the money he made on the way to you to replicate other people's successes. I think that's a fantastic contribution to society. Well, let's start with contribution to society. I was 12 years at a bank which went bankrupt. I brought the biggest bankruptcy to society. And on that way, more or less involuntarily, I became an entrepreneur myself, like you. And we had a big issue. We had no name. I called my company Marco Rodzynek, Internet and Technology Investment Banking and Consulting, which hardly fit on a website or a business card. So I decided to call the whole thing Noah. And Noah stands for biblical new beginning, but also for no assholes here. And we try to do banking in a different way, and we look for complex stories which we can sell at high prices by making them simple. I'm not going to bore you too much about us, but here's a small team, and what René said earlier, I can say we are looking for over 3 years since we started for the number 4 on the page, and we have been very selective. We couldn't yet. So if anybody has ideas, let us know. It's always good to wait and don't play the wrong card at the wrong time. I'm very proud of having done some transactions in independency. On the right side, you see a few, but I'm not going to bore you with that. Interestingly, I think lesson learned, you don't want to be a one-trick pony. So what we did in order to not be the boring banker, we did a conference, which is great, because suddenly I could not only talk about Lehman Brothers going bankrupt and how I carried out my boxes, but I could talk to people speaking at our conference. And by now I would say that the NOAA conference is established. We are in the 4th year. Last year we had 1,300 people. This year we're probably going to be around 2.5 in London. And in 2 weeks we do something really crazy. We go to San Francisco with 65 companies from Europe telling the Americans that internet is not only invented in the US. We have 800 people showing up for that at the Four Seasons. So let's see. I have a confession to make. 3 weeks ago, the 800 registrations were barely at 50. I don't know, there was some viral thing happening and we managed to get it up very quickly. So that's just a large deal we announced. We sold 50% of Fotolia to KKR. It was a leverage recap. It was the biggest European leverage buyout, so using debt in the internet space. Obviously some commercial here. I'm going to flip through this because you probably read about it in the newspaper. Now, where do we stand on the exit market? And I love the big picture, because big picture means big deals means big fees. So I want to start a little bit on the top. Now, in general, I find, I don't know what you think, but the European exit market have been quite quiet. We haven't seen like the Instagram or, you know, the Groupon IPOs, although somebody could say it's a European company because over 50% of the revenues are in Europe. However, we haven't seen too many of those recently. So there has been a quite modest activity, with one big exception, and there was a question earlier, why doesn't Deutsche Telekom take some risk? Skype, was there any deal you should have done? Maybe. Somebody made a lot of money with that, Silver Lake, and that was probably the most spectacular European, in fact, the most spectacular private equity deal ever in terms of the return, which was sold to Microsoft in a not long time. So lack of large deals, there are some exceptions, but the IPO market in Europe also, and that's the same what we see in the US, they got a bit screwed because the traditional banks, they push it down the pipeline, they call their buddies, buy the stock. We saw it recently, unfortunately, with Facebook, which I think was a very sad story because it's a great, fantastic company, and they created so much nervousness in the market that it takes a spiral, and everybody panics and saying, oh, I don't want to be the last one here, maybe I should sell and see what happens. Two large deals, the Permira AXA private equity deal with Odigio, which is a combination of eDreams, GoVoyage, and Opodo, an amazing deal, I thought. And yeah, then our deal, we are very proud of the Fotolia transaction, which is a marketplace online to buy images. There's significant interest by finance people. And you, when you think about buyers, think about the strategics, of course, the Googles, but also think about the financial people. It doesn't mean you sell your company, it's your career change or it's the end. It could be a beginning. So we do a lot of transactions, we call them personal wealth diversification. It's when one of you have all their money in one company, like Lars at some stage, a lot of money in one company. You want to take a little bit out and then de-risk and go for next journey with a Deutsche Telekom and eBay or whoever. And usually the question is, do I give up control or not? In fact, it doesn't matter. You are the entrepreneur, you run the company, and we saw this with Fotolia, which was the first deal we did where we sold 65% to TA Associates. Although TA had control, who called the shots at the end? The CEO, who remained a 35% shareholder. And he's, by the way, still the CEO, despite KKR having bought another 5%. Sorry, 50%. So M&A processes should always run propriety. And in fact, there's a slide coming later. If you want to sell, never say you are for sale. You have to be very, very smart around dynamics. Let's go quickly through this because I have not so much time. We think there are 50 companies in Europe worth over $500 million. And in fact, we have a backup for that. We only do internet, so we have the luxury of focus on this exciting space. Now, all the question in terms of valuation, usually people ask me is like, hey Marco, is this market hype? What's going on? I think there are some exceptions in the market, but we also see that these stories are not long lasting. I know that people, no idea about internet, sold shares in Zynga, Groupon, Facebook. They didn't even know what these companies do. They never played a Zynga game, or they don't even have a Facebook profile, but they started trading this. It's a bit like when you get a shoe shine and they tell you, hey, you have to buy the Apple stock. So when this happens, you have usually a hype. And it's true for a few, but not for all. I'm going to show this quickly in valuation. Here's some slides I stole from Klaus Hommels, who presented this at our NOAA conference last year. It's interesting because Europe is, in comparison to other markets, very, very small when you look at the internet public markets, which is also an exit market. I think Klaus has done an amazing job with these statistics. They're so clear. If you look at the big champions coming out of Europe, I would probably add Skype in the middle, but there are not so many left. And Spotify is clearly a prominent example, but Daniel spends most of his time in the US. So we need you. You and this fantastic energy in this room at HackFwd, we need people like you who put all their energy and passion into their startup idea to make this middle much bigger. And in fact, that's also the reason why we do the conference, to illustrate and highlight European success stories the world hasn't seen or hasn't known so much about. When we brought Fotolia to NOAA 3 years ago, the company was barely profitable. Today they make more profitable than their US player, which just goes public, Shutterstock, which has an IPO filing. We're talking around $40 million, $50 million of EBITDA. Internet, man, that's complicated, right? And you should never forget that when you face people, they don't necessarily know anything about your segment, because internet is a parallel economy. You can't expect that the people you try to sell your company to know what you are doing, know your competitors, know your market. Therefore, always keep it simple. Little introduction in every talk, in every presentation. What is it you try to achieve? What's the market? How do you tackle the market? Where do you stand? What's the current metrics, the financials, the KPIs? Because people cannot know all. You're not alone. So this is a map. I like these logos because they are pretty. It's a map of European internet companies. On the left side, we have the ones which we believe are worth over 500 million euros. On the right one, they're worth a little bit less, but they're also very substantial. These are just my personal estimates, so please don't take it for granted if I'm not correct here. So what is a high valuation of a deal anyway? Talking about high valuations. First of all, valuation is only one substance. There's a lot more. So the terms. Everybody can achieve a high valuation if you promise the world or if you give up your whole company. So you always have to look at the balance of different terms. Valuation on one side is obviously important. On the other side, loss of control and investor rights is the other one. So not every deal is created equal. Sometimes you lose in the long run by giving liquidation preferences. I don't know if you're familiar with these terms, but you basically treat the investor different than your own capital. So you push out the bad news to later. Now, this for me, as a banker, is the most important slide in the 68-page presentation I'm going to give to you. This page for me is everything, because when we talk about valuations, it has to be in context where you are at your lifespan of the company. And when there's nothing, just a team, they look at the management team. And there are examples like Branch Out. They haven't even had a business plan. They raised $25 million based on serial entrepreneurship. Stage 1, you want to be a good team. Stage 2, you want to have your technology up and running. Spotify raised at a valuation, I think close to $300 million, a lot of money because they had the fastest, the user-friendliest, and the most disruptive technology in the music industry, and they got some VCs jumping up on it. Now they're much further down to the right in the chain of valuation. The next one is KPIs users. So I did a transaction for Softonic. They had a lot of users, over 120 million, but they didn't have too much EBITDA, but we got value on users and KPI. The most prominent deal on users KPI is probably the AOL acquisition of ICQ in, when was it, 2000 or 99? I forgot. But did you know that ICQ did 16,000 revenues at the acquisition, and 4 months later they had an EBITDA of over 100 million? Why? Because AOL brought the synergies to ICQ and they put advertising on this little application, and it was an expensive deal. Everybody thought, hey, they just buy traffic. In fact, they bought some of their own synergies. You always should know when you sell your company, do they also pay for their own synergy? They should if there's another bidder, and then you can let them compete. And when you have a good banker, they know how to do that. The revenues is the next stage. So once you have the technology, people want it, you scale to users, and then you start with the revenues. And as I said, with the conference business, the first should always be free. And then you start charging. Don't charge at the beginning, and when you charge smart. Don't do a one-size-fits-all. Very interesting in the online gaming industry. Subscription games disrupted console. Subscription games got disrupted by freemium models where you have a different pricing structure, and now you have social and mobile, etc. But pricing was the reason why the subscription model has not withstand new models like the freemium, where you have like something for free first, or you upsell. You have basically a, call it pricing strategy by confusion. Lastly, my favorite column here is the EBITDA column, because that's the most concrete things to value companies on, because that's a kind of, probably heard about it, cash flows, sounds a bit far away at the moment, but this is the discounted cash flows brought on a point where it should equal the value of the company. And lastly, you get a premium for market leadership and actually predictability. And now let's talk about valuation. So the valuation goes up logically from left to right. However, what also goes down? The uncertainty. The closer you are to EBITDA, the uncertainty is smaller versus at the beginning. And also the valuation multiples of revenue go down from left to right, and it becomes a much more, to justify thing. And you should always answer yourself the question, what can the buyer really pay to not look stupid in front of their colleagues in case of a failure, what is justifiable? And I love this like formula. I'm not a mathematician at all, but growth times margin, power to predictability should be the valuation multiple, whatever that means conceptually. So let's talk a few minutes about valuations, where we stand. First of all, valuations in February are down 20%. And you see that this is an EBITDA multiple, the value of the company in relation to their profits, and you pay a factor. So here you see like a universe of e-commerce, classified travel. We can make this presentation available for you. But why does it go down, the blue to the gray? It's 2012 and 2013. If it doesn't go down, what happens? The EBITDA would go down. But usually internet growth, therefore the multiple comes mathematically down. And the PE is the earnings. It's basically depending on the capital structure. But this is all a little boring. Here's like there's an interesting one, because I don't know if anyone of you ever looked at Amazon. Amazon is like really expensive. Why is Amazon so expensive? Because everybody knows Amazon will be the Walmart of tomorrow. But nobody knows when. And in fact, if they continue like that, they're becoming 10 Walmarts, because they invest so much in infrastructure that they always, not always, but often miss their earnings, which is highly frustrating for shareholders. But people know nothing can make Amazon fail. It is just huge. Therefore, it's trading at the highest multiples in the industry, and sorry that the numbers are so small. We looked at Europe versus the US, and also Asia and Japan. And as you see, the US, surprise, surprise, is also in the public market valued the highest. And you should always be aware of that. When you talk to the US investors, by the way, rule number 1, I forgot, it's not even the presentation, never talk about the valuation of your company. Never. It's like talking about your looks at a date. You don't want to do that. You keep that for you, because there's no upside. They may have a higher or a lower view. If they have a higher, then you missed out. If they have a lower, you scare them off. Never talk about valuation. And whoever your advisor is, don't let them talk about valuation. Nobody does that. It's the worst thing, and there are press releases coming out, and there are many examples, I don't want to name specifics, where deals got destroyed by setting expectations too high and shy off a lot of people. You want to upsell slowly. Okay, who are the buyers? So it's not only Google. There's a whole group. There's internet, large cap, family offices, VCs, private equity, hedge fund, traditional. Don't think of just one buyer. Be very open. Some US logos here. Most of these guys are coming to our conference. These were people at our conference last year in London. So we differentiate between venture capital. These are probably the folks which are more relevant for you right now. Growth capital, and then later private equity. And we differentiate by the size of the equity check. So the bigger the funds, the bigger the pocket. And like you, they don't want to work on like 20 or 30 projects. They want to work on 3 or 5. So they try to put as much money to work that they don't have to work as hard. It's like bankers. We like to work on big deals because it's the same work than on little deals. You always have to be aware of that these kind of size differentiations are very important. So before you speak to any investor, check what is the preferred equity investment sweet spot. What is the size they usually do? Is it 1 million, 5, 50, or 500? Because you waste a lot of time and energy speaking to the wrong people at the wrong time in the development. But we can help you with that. How to sell? So this page, I first had 2 bullets. It's basically the lessons learned of my like 15 years career. What I learned in M&A. And I just put it on, and I'm sure you get the presentation anyway. So, I mean, there's some very basics. Don't sell unless you have a plan. Never really put the company up for sale. It's not good. You want people to do the work, and René is not here anymore, but the big company frustration we have, that people, they don't have to do the deals. So you have to give them also an excuse to do a lot of work. So actionability must be there, but don't be desperate. Always say you have several options. Don't be greedy. A good day today, a good deal today, oh, a good day. A good deal today is better than a great deal tomorrow. And we have some experts in Germany, the Zamvers, they always know, zack, 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 one after the other, because then they move on to the next. So never have like your dream number in the head and block a process. Always be flexible. And I like this one, work with a professional banker. I think that's really important. I think it's probably the most important on this page. Always work with several people, not one. Not the loudest is the one which ends up. I never had a deal where the first was the last. The first contact, the keenest, won the deal. I never had that. Maybe it's just coincidence. There's 3 prices. The price you want, the price the best buyer is prepared to pay, and the price the second buyer is prepared to pay. You never want to talk about yours. And when we do a process and people ask us, hey, what do they want? How much? I say, I really don't know. There's a lot of interest. And I only know one thing. For you to win, you need to be higher than number 2. You want to be honest, simple, and analytical. You only win through analytics because people need analytics to justify spending a lot of money. What drives valuation? Well, it's cash flows. At some stage, hopefully, there are cash flows. And if it's not yours, it's the synergy cash flows, which are important. Market size matters. I've seen a lot of internet companies playing in a too small niche where people just scratch their heads. Yeah, well, how big is that market? And it's crowded. That's key. You want to give at least a vision for bigger. You always need the dream page. Like, I'm here and I can go there, especially with your help. And then you make them feel important, and then they think they add value, and they feel even better about themselves, and they're proud when they come home and tell their wives what they have done the day. It's all about psychology. Comparable companies and transaction analysis gives you an idea about multiples, but just remember one important thing. A stupid deal in the market does not mean it needs to get repeated. So how often do I hear, yeah, but this company bought this company, and mine is much better? Yeah. There's the reason somebody made a mistake and they got slapped. And I can tell you many, many examples. They lost their jobs. You don't read about that. You only read about the press release and the big quotes. But then people lose their job because they overpay in a weird region or something. I mean, there are many examples. Never, ever look at other deals. Always focus on yourself. And try to understand the buyer. Forget the public market as part of that. Now, what I don't like about my job. My job is hard work. Unfortunately. And the worst is, there's no such thing as an easy deal. At least I haven't had the luck yet. It's always hard work, and you have to be 100% prepared. And the odd question will come. And when you don't deliver, you have a problem. You want to dictate the timetable, and you bring everyone on one page. It doesn't make sense to be with the fastest very quick, because you lose all the others. You have to bring people on one timeline. Very important. Never, never, ever overpromise during the process. If you promise projections, KPIs, financials, and you don't hit them, you lose the entire credibility and the deal is dead. What do you want to do? You want to be like 10% below what you think is the worst case. This is deal failure reason number 1. Underperformance during M&A. Now, there are many buyers who want to hear your story, but you have to tailor them. You can't use the same presentation for everyone. Sometimes, and that's a really tough lesson learned, you have to put like the synergy page in, or that you really thought how you want to join the Deutsche Telekom, and you know how it fits. You want to give them the feeling that they matter to you. Now, never give people the understanding they're alone. It's kind of obvious. Why is it a tough lesson? Because they always give you a lot of pressure, and they threaten that they don't put the resources. And there is a point in any deal where it starts costing money for the buyer. And that's when they hire a lawyer who drafts the document and an accountant. And an accountant checks the financials. So try to delay exclusivity as long as possible and make them spend money without getting married to someone as of yet. You always want to have like 2, 3 people. Motivate. You have to be positive. It's a love story. Be patient and don't rush. Probably the most important. Here's just a little timetable on how we do these things. So you do approach, where you prepare, then you have your management presentation, and then they do the due diligence. Usually a deal should take 4 to 5 months. We have done faster, and we have taken a lot longer. Detailed timetables. You know, these are the things people write and then nobody looks at. It's hilarious. But we have them in our presentation because people expect them from us. Now, these things are kind of important because you have these stereotypes in mind when you select bankers and when you work with bankers. Forget all of them. You just want to trust whoever you work with, and you want to really ask for advice. And when there's somebody who has a view, timetables don't matter, you always need the next date. That's the thing which matters. Forget about the day after. The next date is what you have to be focused on. Because if you have a page like this, you're not focusing on the next. You're cluttered. Your brain is switching off. Always think about what's the next step I have to do to go further. Investor materials, you want a company overview. Don't write these long information memorandums. They're an ultimate evidence that you're talking to the entire world. Think about this. If you get a book like this, everybody knows, oh, they didn't write this for me. However, if you have a crispy 30-page document, you can always say, we just used it at our last sports presentation for an update. And we are talking to a handful of people. You're one of them. And in fact, we like you most because you bring the biggest synergies to us. Make the story interesting. That's the structure of a presentation. Also, this we can leave you for thoughts. Here's an example. Now, analysis is everything. So here we did a page. We looked at classifieds in Europe. In fact, René would have been interested in this slide. These are our estimates again. We looked at usage and financials and EBITDA. Kind of going the value chain of the internet again, right, of valuation. We start with usage, revenues, EBITDA, and maybe the last column is the most important one for valuation. However, we see like some interesting differences, like Sahi Binden is number 3 by minutes spent, but they're nowhere in EBITDA. Maybe there's the biggest growth. These kinds of things is just an example. Okay, I'm getting cut off. Good. This is another topic. This is how you create a public profile and people know about you. These are some examples who has done it right and wrong. And my favorite page, how you select an advisor. Okay.